Okay, welcome back. We're going to do question number 3. This question tests your understanding on adjustment as well as how to include the adjustment in the 10-column worksheet. Okay, let us read the question first. The ledger of P. Odell Veterinary Surgeon contains the account and account balances shown below on 30th June 2016. So we have a long list of accounts here: cash, account receivable, prepaid insurance, land, building, accumulated depreciation, equipment, and also accumulated depreciation for the building. So all these accounts are your assets accounts. Followed by liability, you have all the payable. You have two payables here. This is your liability. And then your capital and drawing, the offset for capital is your equity. And then we have fees earned, rent revenues. Both accounts are your revenue accounts. And we also have four expenses. Yeah, four types of expenses: salaries, telephone, interest, and insurance. So this is your expenses, your expense accounts. Okay. So the following title are included in the chart of accounts. You are given this account title. It help you to answer this question. You have the idea what you're going to do. Interest payable, salaries payable, rates payable, unearned fees, depreciation, and also rate expense. So you're given this. So this help you, inshallah. Yeah. So let us go one by one from adjustment 1 to adjustment 6. Adjustment number 1 is rates owing. Owing means you still not pay that. There's your liability 4820, 4,820. So how are you going to do this? Let us go and check our accounts. Do we have any rates expand here? No, we don't have any rates expand. So we're going to include new expand there, rate expand. What is the effect of this transaction? It will increase your expense, okay, and it also increase your liability because you don't pay it yet. So what kind of expense is that? The name of this expense is rates expand. And the name of the liability is, maybe you should put rates payable. Let's put that payable. Payable means you're going to pay soon. This is your obligation. So if you go back to the formula that I always give you, rate expand, you should debit, increase in expand, and rates payable is credit. You have to go back to the main formula, asset, liability, and not asset, liability, and equity, sorry. Asset, expand, and drawing, plus, minus, and then you have liability, capital, and revenue, credit, plus, and minus. Yeah. So how are you going to do this? Okay, we go to our accounts. Now let us, since we don't have both accounts, so I'm going to record this under our adjustment, yeah. Rate payable, I'm going to credit that account. So by 4820, and your rate expand also increase by 4820. So this is how you're going to do this. Yeah. One debit, another one will be credit. Increase in account payable, liability increase, expand increase. That is for adjustment number 1. Rates owing is like you receive a bill from DEWA. This is the electricity or energy or water company in Dubai. When you receive the bill, your expenses increase. You don't record your expense until you receive the bill. For example, for this month, I haven't received my DEWA bill yet. Yeah. So I'm not sure how much I'm going to pay. When I receive the bill, then my liability increase, my expenses also increase. So debit rates expand, credit rates table. So that is for number one. Okay, let us move to number two. We have two items in number two that is both are related or both are on depreciation. Number one is for equipment. You're going to provide depreciation T3680 and for building 9,600. So you have two items here. Let us do one by one. So depreciation, when you provide depreciation, your depreciation expense will increase. Your depreciation expense, this is your expenses, it will increase. So you're going to debit this account. Yeah. Depreciation increase, expand, debit. This is expense. Yeah. And your asset will reduce. The asset value will reduce. So we have another one, accumulated depreciation. This is your contra asset accounts reduce. So I'm going to put here credit. Yeah, this will increase. Why this increase? Increase in accumulated depreciation reduce the value of asset. So it's credit. One debit, another one is credit. So we need to check our accounts for the equipment. For the equipment, we already have 8,800 credit. So we are going to add another 3,680. We're going to add 3,680. So how I'm going to do that? We go back to our worksheet and then please find the equipment. This is credit. We're going to add one more and we're going to add adjustment for this 3,680. So you get there 3,680. We don't have depreciation account, so we're going to create a new account for depreciation debit. Depreciation for equipment, the amount is 3,680. 3,680. So one debit, another one will be credit. So you're going to do the same thing. You're going to do the same thing for the second type of asset, that is building. Let us go for building. The amount is 9,600, the depreciation. So I'm going to increase the accumulated depreciation for building by 9,600. So if you check the value later on, it's going to be 86,900 credit with another credit, means the value will increase, the amount will increase to 96,500. For the equipment, accumulated depreciation for equipment, originally the value is 8,800. You credit another 3,680. So the new value will be 12,480. Yeah, increase in the value. So let us do for the second type of asset, that is building. You're going to debit that by 9,600. So always remember, for your depreciation adjustment, the correct answer, the correct adjustment should be debit depreciation expense, credit accumulated depreciation. Number three is an advance fee payment of 600 for minor surgery to be performed next month, July 2016, was credited to fees earned. To fees earned. What does it mean? In our fees earned, we have fees earned here. This is our fees earned 262,430. It include an amount of 600 for next month. So we need to take out this money. Yeah, we need to take out this money from fees earned because we haven't earned it yet because we don't provide the service. Yeah, we're going to provide the service next month. So it's going to be unearned fees. This is our liability. Yeah, this is not our money. The amount will be 600, and our revenue should be not be 262,430. Our revenue should minus by 600. Why? We have not performed the service yet. That's the reason. Always remember, in accounting, we use the accrual concept. We only record revenue when it is earned, and we record expenses when it is incurred. Okay? Not based on the amount of cash received or paid. So I'm going to reduce my fees earned. This is debit. To reduce this, this is credit. So I'm going to debit my fees earned. I'm going to reduce that debit by 600, and I'm going to put it as under liability, that is unearned fees credit by 600. Reduce the fees earned, and then I'm going to increase the liability. So let us find where is our fees earned, 26,000. Okay. So I'm debiting the account by 600. So my balance will reduce. My balance will reduce to 261,830 because this is credit. The adjustment is debit. So credit and debit, they will offset each other. So credit minus debit, 261,830. And then our unearned revenue here will increase. Our liability here will increase by 600. 600. So we'll get 600 as the new value. So this is what you're going to do next week, inshallah. Okay. That's number 3. Let us move to number 4. Okay. The mortgage contract provide a monthly repayment 1,000 plus accrued interest. The June payment was not made. You don't make the payment for your loan, and you have interest 260 accrued. Accrued means you're not paid yet. Yeah, the amount is 260. So in that case, you need to record this as your expense. Your expense increase and your liability also increase. What is the name of the accounts? Interest expense, and this one should be interest payable. This is liability. Increase expense, debit. Increase interest payable, credit. Debit and credit. So you're going to do this adjustment. Yeah. Increase in expenses, increase in your interest payable. Your liability increase. Similar analogy can be given that I gave you before when we receive the DEWA or electricity bills. So your interest expense will increase. Debit, I'm going to debit some more. So your interest expense debit 260, so it will increase to 3340. Your interest payable, we don't have any interest payable accounts here. So I'm going to put the interest payable credit 260. 260.
Professor, I have a doubt.
There's a question, a good question, yeah, from Diwanshi. about the 1,000. The 1,000 is the monthly payment, okay, and we need plus the accrued interest. So you should pay 1,000. 1,000 is the payment of the loan principal. It will reduce your liability, the principal of your loan, by 1,000. And 260 is the interest charged by the bank. So if you make the payment by cash, your cash will reduce by 1,260, your loan will reduce by 1,000, and your expense will increase by 260. This is if you make the payment. Okay. However, you don't make any payment, so your principal, your main loan will not increase. It will be the same. So no change in your loan, no change in your cash. However, your expense still increase. You still incur the expense 260, and your liability also, your expense payable also increase by 260. So this is the reason why we need to debit our interest expense, debit by 260, and we're going to credit our interest payable credit by 260. Yeah, interest expense, debit 260, interest payable credit 260. Okay, that's for number 4. Let us move to number 5. Number 5 is quite easy. Okay, we have this prepaid insurance 1340 has expired. Okay, we need to check our total amount of prepaid insurance 1,800. So from 1,800, okay, the amount expired is 1340. So we need to minus this 1340, and then the balance will be 460. So this is the balance. So how are you going to record this? This amount expired, or I can say used or incurred. So this will be your insurance expense. Insurance expense, debit by 1340, and then this is our assets, prepaid insurance. I need to minus this by 1340. Assets plus minus, to reduce, you need to credit the accounts by 1340. This will be your prepaid insurance accounts. So the answer will be debit, insurance expense, credit, prepaid insurance. Okay. So your prepaid insurance, I'm going to credit by 1340. So the new balance will be 460. Debit, credit mean 1,800 minus, because one debit, another one is credit. So the new balance will be 460. The new balance will be 460. And your insurance expense, here you have your insurance expense. The existing one is 36480. When you debit the same amount, another amount 1340, your insurance expense will increase to 37820. How did I get this 37820? Debit and debit mean plus. So 36480 plus 1340, that give you 37820. Okay. Next, we move to the last one. Salaries earned but not paid amount, okay, to 2,360. This is the expense. our employees deserve to be paid by this amount because we already closed our account. So this fall under salaries payable. So your salaries, the salaries expand increase, the salaries expand, okay, increase, okay, in debit, and your salaries payable, yeah, your salaries payable also increase, this will be credit. Yeah, this is your salaries expand debit, salaries payable credit by 2360, by 2360. So let us find our salaries payable here. We have zero balance. So when you put the balance credit there, so you will have a credit balance of 2360. And your salaries expand will increase from 12460, increase, yeah, increase to 126960. So we have done all the journal entry. If you want to check your answer whether you do it correctly or not, you should total your debit and credit. Total your debit and credit. MashaAllah, you get total of 22,600 for your debit and credit. So you get full mark for your adjustment here. Total debit and total credit should be the same. Okay, very easy. And then for each account, you need to come out with the new adjusted trial balance, okay, and then transfer to income statement or balance sheet. Let me do it one by one. Let us do the asset first. So this is your asset. Let me just put this is your assets. Doesn't look like that here. 1 minute. This is your assets. Okay. For cash, the balance is 12600. There is no adjustment for cash. So your adjusted trial balance should be 12,600. And asset should go to your balance sheet. Debit, and this is debit. For account receivable, the same thing. There's no changes in account receivable, no adjustment. So the unadjusted balance is 11,800. The unadjusted balance should also be 11,800. And this amount should be recorded in your balance sheet, 11,800. So you do all this for assets, okay? Including the contra asset account, that is depreciation, accumulated depreciation for building 86,900, but we have some adjustment there. So our accumulated depreciation for building increased to 96,000, and while for accumulated depreciation for equipment increased to 12,880. So if you notice that this account, they have this credit balance. So I'm going to put that on the credit side of your balance sheet. It will reduce the value of the asset. So for accumulated depreciation, for contra account, it will always on the opposite side of the primary compared to the primary accounts. Okay, so for prepaid insurance, we did some adjustment. We did reduce the amount of profit insurance by 1340. So that is the balance. That's why the balance is only 4,000, not 4,000, 460. So this is for your assets. It's very easy. Plus, sorry, debit plus debit and credit is minus, credit and credit should be plus. So that is the formula. Next one, I'm going to do for liability. Liability, this is your liability account. Okay. We don't have any amendment, adjustment for liability here, so it should be the same and liability should go to your balance sheet. So adjusted trial balance, you put it, transfer the original figure, the unadjusted figure, to the adjusted trial balance. And from the adjusted trial balance, we move to the balance sheet on the credit side because this is our liability. Okay, this is our liability. For capital, on the top of that, we also have liability down there. Okay, for example, rates payable. So this is our liability. This is the liability. And then we have interest payable, salaries payable, unearned revenue. So we have another four liabilities here. Before this is zero, we credit the accounts. That's why the adjusted trial balance, we have a credit balance of 260 for interest payable, 2360 for 2360 for salaries payable, rates payable 4820, and rate expand 600. So these are all fall under your liability. So I'm going to put a different color for that. Yeah. Maybe is it yellow, a good color? Maybe green. Green. And this will also be green. So it help you to understand the categories. Oh, not similar, yeah. Same categories of assets. Okay, of accounts. Sorry. Next will be your capital and drawing. This is your capital and drawing. It should go to your balance sheet account. So no change in your capital. So the amount should be the same. 236950. Your drawing also no change on that. So it should be here 86,900. So both items should be sent to your balance sheet. Should be sent to your balance sheet. So there's no change, and then going to record to your in your balance sheet. Your balance sheets. Okay, in your balance sheets. Okay. For your fees revenue, there is slight change there. Fees revenue increase, no reduce by 600. So the new value is 26830, and these are all your expense and revenue accounts under under profit and loss account or income statement. So I'm going to transfer this to the income statement. Income statement. Yeah. So we have income statement 261,830. So that is your revenue. For rent revenue, no adjustment. So in your adjusted trial balance, the amount should be the same. That is 14,400. And I'm going to transfer this amount to your income statement. Transfer this amount to your income statement. So for other expenses here, salaries, we have some adjustment. But for telephone, we don't have any adjustment. It should be the same. Should be the same. For interest expense, there is some adjustment. There is an adjustment there. Insurance expense also we have one adjustment. So all these are your expense, the new value and your adjusted trial balance. So we are going to put this value in your income statement. So this will be the new value in your income statement, 126,980. Okay. Depreciation expense also increase. Before this, we don't have any depreciation expense incurred for current year. So now depreciation expense for building is 9,600. For equipment is 3,680. So all these figure will go to your income statement. Before that, your adjusted trial balance. So this will be the amount. Yeah. Okay, so we have done with the adjustment. So how to check your answer? We need to do the total, except for rate expand. One more item, rate expand here. Sorry, rate expand is 4820. So how to check your answer? The next step is to calculate the total debit and total credit balances. So when I do this, it should balance, whereby I found that your balance, the balance is 710,600 and 710,600 for both debit and credit. Okay. However, for your income statement, the total debit and total credit won't be the same. It depends on whether you are making profit, loss, or break even. If you are making profit, your total revenue would be higher than your total expense. If you are making loss, so your total expenses is higher than your total revenue. So you need to total this income statement, and when you total this, you found that the balance, the total of revenue is 276,230. However, the balance of your expenses is very low, yeah, only 190,740. So your revenue is much greater than your expenses. So the amount, the big difference is your profit. So I'm going to put the difference there. How to do it? The difference here is on the debit side. 8985,490. So that by putting this, we already identified what is the difference. So this is the profit for the year 8540. 8540. And then this is the increase in capital. So in your balance sheet, I'm going to credit the accounts by 8540. This will go to your capital accounts. Yeah. So this is how we balance the account. If you don't include the capital, the profit here, you won't able to get equal debit and credit balance. Yeah. You can see that your profit, your total asset is 519,860. Your total credit is 434,370. Mean your total assets is higher now, increase. Yeah, the different compared to your liability and capital. Why? Because we have a difference in 85,000. This is the capital, the profit gain during the period. So if you include the profit, you will have a total debit, and total debit is equal to total credit. So this is the technique that you should apply to prepare your worksheet. Hopefully you can understand this and score a good grade in your final as well as your quiz. The last part is to prepare from here how you're going to prepare the income statement and a statement of changes in equity and balance sheet. You already know the answer. Your profit is 85,000. Yeah. 85,000. So the next step is just to reformat this, use the same information here, translate it into the easier format for users to understand. So we're going to put the statement there, put the title first, income statement, and then divide into two sections, income and expenses. And then you put all the details. So your income, we have two types of income, as I mentioned before, 261,830 and 14,400. So you put it here, all both figure. You put both figure, and then you have the total figure. This is your total revenue. And for your total expenses, we have many expenses now. We have 1, 2, 3, 4. This is the original one. The value is 1, 2, 6, 4, 5, 3, 3, and 3, 7. And then we have a new one here, expenses, 4820, and also depreciation expense for building as well as for equipment. So we have seven expenses. So you're going to transfer that figure to this statement, and then you'll get your total expenses. Total expenses 19740 should be equal with this figure here, 197. If you still remember 197, 190, just put in different color. Yeah, this is 190,740,276,230. So this is what the values from the worksheet, and then your profit will be the difference between your total revenue and your total expenses. 85,490. This also 85,490. Okay. So, so we're done with the income statement. The next one, you're going to do your statement of changes in equity. There are only three components there. The first one is the capital, the profit for the year, 85490. So I know the answer is 89490. And then we also have drawing. So from your trial balance, you should know what is the amount of capital. 236950 drawing is minus 86,500. So include that information in this statement, and then you will get the the correct answer for your capital. The new capital amount is 235,940, which is equal to 236,950 plus 85490 minus 86,500. So this will be your new capital accounts. And the last statement you're going to prepare is your balance sheet. What is balance sheet? List of assets, liabilities, and the amount of your equity. Asset is equal to liability plus equity, or assets minus liability is equal to equity. So this figure 235,940 should be your total as total equity. So this should be your total equity, 235,940. And then your task is to divide whether it's current asset or non-current asset using the item that we have not used. This one on the top here. This is all assets. This is all liability. And we also have some liability down here. Yeah, interest payable, salaries payable, unearned revenue. So this is all our liability. So using this one by one, for example, asset. How many asset that we have? 1, 2, 3, 4, 5, 6, 7, 8. Yeah, 8 accounts here. 1, 2, 3, 4, 5, 6, 7, 8. So we're going to put all that items in our asset category. So the total of our assets, 1, 2, 3, 4, 5, 6, 7, 8. How can we have? No, 1, 2, 3, 1, 2, 3, 4, 5. So the total is 8. So the total asset is 324,380. And then you put your liability. Okay, we have liability, long list of liability. We have 1, 2, 3, 4 liabilities accounts. And then we have another 2 here. Then it should be 6. So 1, 2, 3, 4, 5, 6, 7. So something wrong with my eyes now. Yeah, yeah. 1, 2, 3, 4. Only 4 here. Only 4. And then your only 4 there. 1, 2, 3, 4. And then this account payable and mortgage is your liability. So 6. 6, yeah? 6. How did I get 7? So 1, 2, 3, 4, 5, 6. Oh, this is where we break down the loan there, okay? So this is the unearned fees, 600, and the mortgage also, another thing. The mortgage payable is 51,000. So 1, 2, 3, 4, 5, 6, 7. Account payable, account payable. Yes, we have account payable. Yeah, we have account payable, mortgage payable, 64,000, 64,000 here. So I think they split it into the current and non-current. The non-current will be, the non-current will be mortgage payable. Okay. Account payable, 16,400. This is your account payable, 16,400. Your mortgage payable is 64,000. So the mortgage payable is 64,000. Your mortgage payable is 64,000, but they split the mortgage payable into the current portion as well as the long-term portion. So 64,000, 1,000 per month. So in the next 12 months, you're going to pay 12,000, but you also have outstanding here 13,000. So the long-term portion will be 51,000. What does it mean here is because we have current and non-current liability, we have 64,000 is our loan. So within 12 months, 12,000 will be your current and the balance is non-current or long-term. This one is still long-term. So we divide the portion, but I don't expect you to do this as long as you can give me 64,000. That means you understand the classification of asset. This is a bit advanced. We're going to do that later on. Yeah. So this is how you answer question number 3.